Hi, I'm Barry Norris, the fund manager of the Argonaut Absolute Return Fund, and this is a short presentation on what we think is unique about the fund as a regular investment product. So the fund is composed of two separate portfolios, a long book of stocks we like, which we expect to rise in price, and a short book of stocks we don't like, we expect to fall in price. And this makes the fund different from most other funds which are dependent solely on asset appreciation. We've been doing this for over a decade, and on average, we've delivered a double-digit annualized positive return. But moreover, the return profile is totally uncorrelated to the market. And we think that makes it particularly valuable, where in an investment world where crude market exposure or beta can be bought cheaply through passive funds, we believe that our return profile is valuable, as it cannot be easily replicated, and it diversifies investors away from over-reliance on market appreciation. And as we have seen in 2020, it is not wise for all of your savings products to be dependent solely on positive market outcomes. So the fund is composed of two separate portfolios: the long book, stocks that we think will rise in price, and a short book, which are stocks that we expect to fall in price. We identify these stocks for our own analysis of businesses in different industries, and it's very important to do your own research and come up with your own ideas. We call this double alpha, or the ability to generate excess returns from both long and short books. So if you look at the blue line here, this is the excess return from the long book. The red line is the excess return from the short book. We combine them together and we get the power of double alpha, which allows us to generate potentially better or excess returns from long short than what we would do just running long only funds. So this also gives us a return profile which isn't dependent on market direction. This means that we can generate an attractive return profile, but also a return profile that would deliver at different times in the market, and therefore of most other funds. So this gives us a profile which truly diversifies your investments and means that you're not putting all your eggs in one basket. So unlike most other fund managers, we short sell stocks. These are stocks that we think are overvalued and will fall in price. We identify these stocks for our own analysis. No company or sell-side research will highlight the shortcomings of companies. So our short portfolio has underperformed the market by nearly 100% over a decade. Strangely, this is good news, meaning that we have added considerable value for our stock selection, because remember, we are essentially wagering that these stocks will fall in price. So we look to select shorts on three criteria: flawed business models, deceits or frauds, or over extrapolation of growth. And we look to diversify our short portfolio by position sizing and ensuring that all the companies we don't like are not all in the same places. Positions are taken via CFDs with prime broker. Think of this like a bookmaker who pays out when the funds win. And short selling, I think, is often seen wrongly as immoral, but in fact, I would argue it's the complete opposite. Short sellers hold public companies to account. We are the market vigilantes, ensuring integrity in public markets. No companies go bust because of short sellers. Companies go bust because they run out of cash. Without short selling, the entire investment industry would simply all want to see share prices go up with limited scrutiny, and all savings products would therefore be totally dependent on a continuation of positive outcomes. In other words, the stock market will be rigged to the upside, creating a misallocation of capital. Short selling is also a relatively rare skill in the investment world, where most people are employed by funds that are mostly dependent on prices going up. We can also see how the fund has performed in its best and worst months for the market, and how the market has performed in our best and worst months. We can see that in our best 10 months, where in total we have delivered an 80% return, the market has delivered a negative 10% return. In the worst 10 months, where in total the market has delivered a total return of minus 77%, the fund has delivered a positive return of 17%. So the best months for the market and our worst months have also been entirely uncorrelated. This is intentional. Uncorrelation also means that we will not necessarily go up when the market goes down and vice versa. We are just not dependent either way on what the wider market is doing. So whilst our returns are by no means guaranteed, and we cannot control the short-term share prices, and indeed sometimes we will make mistakes, our successes and failures will likely come at different times to everything else in your portfolio, which is valuable from a diversification point of view. So we aim to generate non-correlated returns, and we've been pretty consistent at doing this. So let's have a look and see how we've done in months where the market has delivered a negative return. So since launch, there has been 53 negative months for the market in which we have produced positive returns in 30. And overall in negative months, we have generated a positive return of 24% against minus 81% for the market. That gives you a good idea of the benefits of an uncorrelated long-short fund. So there are two reasons why I think these non-correlated returns are valuable. I think year to date, the folly of diversification through long-only funds or indeed low volatility funds, which are mainly highly correlated to the market, has been exposed. We saw in March how almost every single fund went down in price to a precipitous degree. We also see that people need access to their savings often at difficult times for the global economy, and too many people have savings products which are entirely reliant on bull market positive outcomes. Our fund is truly unique in the UCITS world in offering equity type double-digit returns which with non-correlation to the market and other funds, and we think this diversifies every portfolio. So we're going to just finish by looking at some myths of absolute return funds and working out why Argonaut is different. So typically, it's true that many absolute return funds deliver only modest cash type returns, but we believe we offer something more ambitious and valuable. Our annualized return since launch has been double digit, and that's certainly a lot higher than cash type returns. And in a bull market, or what's largely been a bull market, we've generated positive returns from our short book in 7 out of 11 years. Number 4, these structures are sometimes thought to be unfair to investors. Well, we certainly are not a cheap passive product, but we actually do something for our active management premium. And our returns, it's often are forgotten, all of our returns are quoted after all of our fees. So the return profile that you see quoted is the return profile after all fees. And I think there are some funds in the sector that are maybe targeting very low returns where their fees are very high relative to the returns that they're targeting. And I would say that perhaps those aren't great value. But as I say, all of our returns, which have on average been double digit on an annualized basis, are after all fees. Number 5, absolute return funds are only necessary if you are bearish and holding that view. Cash is king. Well, it's important to remember cash has no return. And if you have that view, you're highly reliant on market timing. Cash has a negative return after inflation. And we certainly offer a different return to either market beta or to cash. Number 6, returns from long-short equity are too volatile. Well, our volatility has been fairly consistent at 8 to 10%. That has been on average less than the market volatility since we launched the fund. Our drawdown risk has almost exclusively been related to style risk, i.e. When our process has temporarily not been rewarded by the market. But I think now we've we better understand this and understand how it's important to mitigate this risk through diversification. So, and overall, I think the fund should be viewed as a diversifier. Number 7, it's often said that absolute return funds have opaque investment processes. They invest in complicated derivative instruments and invest in assets where price discovery is difficult. Well, our process is very simple. We only invest in single stocks, both long and short, and these are selected through fundamental analysis based on our understanding of earnings surprise, i.e. whether companies can beat or miss their earnings expectations. Number 8, funds have a mismatch between investor liquidity, which is often daily, and underlying liquidity. Well, we've been running this fund for 10 years. We've had periods of time where we've seen big inflows into the fund and periods where we've seen big outflows. We've always been able to meet any liquidity calls, and that's never affected the performance of the fund. So in other words, all of the assets that we've been investing in have been very liquid and reasonably straightforward to turn into cash. Number 9, a big team or even a big computer is needed for alpha generation. Well, I simply reject that. Argonaut's best performance has been consistently negatively correlated to team size for more than a decade. It's not the size of the team that counts, but its ability to generate superior investment returns, and indeed a bigger team can often get the fund manager bogged down in groupthink. And finally, number 10, low correlation to the market can only be generated by money for money market neutrality. And in other words, for every pound that you are long of the market, you must be a pound short of the market. Well, we found because our single stocks because our short positions tend to have higher betas or are more volatile, we must be at least 30% net long to have zero correlation. And I think that was highlighted by the fact that in March 2020, this year, where the market collapsed nearly 20% and we made 15%, we were actually 30% net long of the market. In other words, we're making our returns from alpha rather than negative beta. So let's sum up. Our strategy is fairly simple and easy to understand. Since launch, we have delivered on average double-digit annualized returns. Our return profile is not dependent on market direction and is valuable as it cannot be easily replicated, and it diversifies investors away from over-reliance on the market return. As we've seen so far in 2020, it is not wise for all of your savings products to be dependent on positive market outcomes. So I would just encourage anyone not to put all of their eggs into one Argonaut basket, but in my opinion, the Argonaut Absolute Return Fund would be a good long-term egg in anyone's investment basket. Thank you.